Today we're diving into something I've been researching extensively: Greek real estate investment. Did you know that 70% of foreign investors in Greek real estate face legal complications within their first 3 years? That's right. While you might be dreaming of a whitewashed villa overlooking the Aegean Sea, there are some harsh realities you need to understand before signing any contracts. I'm about to reveal 10 pitfalls that local agents will never tell you about. This could save you hundreds of thousands of euros and years of headaches. Let's dive in. Pitfall number 1. The Golden Visa. Greece's Golden Visa program looks amazing on paper. Buy property, get residency. Simple, right? Not exactly. In 2024, they completely changed the rules. Now you need to spend at least 800,000 euros in popular areas like Athens, Thessaloniki, Mykonos and Santorini. That's double what you need to spend in other regions of Greece, where the minimum is still 400,000 euros. What nobody tells you is that this program has created artificial demand in certain markets. According to PricewaterhouseCoopers, 63% of Athens apartments between 250,000 and 300,000 euros are bought by foreigners seeking visas. This might seem like a good thing, but what happens when policy changes or international demand slows? You could be left with a property in a market with no natural buyer base. That's a liquidity trap waiting to happen. Pitfall number 2. The uneven recovery. Greece has come a long way since the 2008 financial crisis, but here's what agents won't tell you. The recovery is extremely uneven. In central Athens, prices are still 25 to 30% lower than pre-crisis levels, while tourist hotspots like Mykonos and Santorini saw property values surge by 20% in 2023 alone. Think about this. Thessaloniki saw about 12% growth in 2024. Good, but nowhere near what the islands are seeing. If you're investing based on national averages, you're making a huge mistake. And get this, about 27% of homes in Athens are sitting empty, many caught in inheritance issues that can take years to resolve in Greek courts. This oversupply affects property values across entire neighborhoods. Pitfall number 3. The tax trap. This is the one that catches almost everyone off guard. Taxes can eat 20 to 30% of your expected returns. Most foreign investors only worry about the 24% VAT on new buildings, but that's just the beginning. Rental income in Greece is taxed progressively. 15% up to 12,000 euros, 35% between 12,000 and 35,000 euros, and a whopping 45% on anything above that. These rates apply whether you're a resident or not. But here's the real killer, the annual NVA property tax. This is based on the government's assessment of your property value, not what you actually paid. Let me give you a real example. A British investor bought a 400,000 euro villa in Corfu in 2019. Their NVA tax started at 1,200 annually, but jumped to 3,300 euros after 2022 reassessment. That's a 175% increase they never saw coming. According to research, 38% of foreign buyers completely underestimate these extra costs. Don't be one of them. Pitfall number 4. The short-term rental reality. Everyone talks about making a killing on Airbnb in Greece, but here's what they don't mention. To operate an Airbnb legally, you need a special license costing between 500 and 2,000 euros annually depending on location. And then I'm not even talking about property management companies where you'll be paying through the nose. On islands like Santorini or Mykonos, there's also an overnight stay tax of 4 euros per room each night during peak season, which cuts into your rental income. Many investors mistakenly think that rental income will be tax-free. Some investors use strategies to lower these costs, such as splitting ownership between spouses to stay under tax limits or declaring a smaller property size on purpose. Though this can lead to fines if caught. And some even time their purchases to avoid reassessment periods. And speaking of Santorini, those picture-perfect cliffside villas everyone dreams about? They're now delivering gross rental yields below 2%, barely enough to cover maintenance costs. The market is completely oversaturated. Meanwhile, university cities like Patras consistently deliver 6 to 8% yields because students need year-round housing. It's not as sexy, but the numbers don't lie. Pitfall number 5, the liquidity problem. Let's talk about something critical that agents never mention. How long it really takes to sell Greek property when you need to exit your investment. The numbers are shocking. Properties over 350,000 euros sit on the market for an average of 18 months nationwide. Those luxury villas in Rhodes that look amazing in photos, they take a staggering 22 months to sell. Almost 2 full years of carrying cost while you wait for a buyer. The regional differences will make your head spin. In central Athens, 78% of 500,000 euro properties sell within 6 months. Not great, but manageable. But in Crete's coastal towns, a mere 12% sell that quickly. That means 88% of sellers are waiting over half a year just to find a buyer. What explains this massive difference? It's all about the local market. Areas where at least 40% of property buyers are Greeks sell much faster. But those Instagram perfect tourist destinations with 15 plus Airbnb listings per 100 residents, those properties take nearly 50% longer to sell because you're entirely dependent on foreign buyers who might never materialize. Pitfall number 6, the maintenance money pit. Let's talk about ongoing costs. Maintenance fees for a 100 square meter property in Greece averages 1,200 euros annually. That's 25% higher than Portugal's Algarve region at 900 euros. Coastal properties face particular challenges. Salt erosion, seasonal closures, and finding reliable off-season management can drive costs even higher. Many investors budget 5% for maintenance, but end up spending closer to 8 to 10%, especially for older properties with character. And don't forget insurance. The National Bank of Greece seismic risk map identifies high-risk red zones in parts of Crete, Rhodes, and Western Greece. Properties in these areas face stricter building codes and higher insurance costs that can seriously erode your returns. Pitfall number 7, the appreciation reality check. How does Greek property really perform compared to alternatives? Over the past decade, a 3-bedroom villa in Crete increased in value by 28%. Sounds decent until you realize a similar property in Malta went up by 42% in the same period. According to Eurostat, Greek property prices are still 18% below their 2008 peak, while Cyprus has not only recovered but is now 7% above its pre-crisis level. Even with the luxury market, prime properties in Spain's Marbella grew by 10% last year, while luxury homes in Mykonos saw only 6.8% growth. Those are significant differences when you're investing hundreds of thousands of euros. Pitfall number 8, the transaction timeline. In Italy, property deals typically complete within 60 to 90 days when paperwork is in order. In Greece, bureaucratic hurdles and outdated land records can stretch this to 4 to 6 months or even more. I've heard from one investor who waited almost 8 months just to verify clear title on a rural property, completely disrupting his plans. Islands that still use paper records are particularly problematic. This timeline affects everything from financing costs to when you can start generating rental income. Always factor in these delays when planning your investment. Pitfall number 8, the location illusion. Here's a counterintuitive truth. The most beautiful, picture-perfect locations often make the worst investments. Let me reveal some hidden gems that smart investors are targeting. In Athens, neighborhoods like Exarchia, Ebelokipi and Kypseli currently offer the best combination of low purchase prices and high rental yields of 6 to 8%. Coastal towns near the Albanian border like Igoumenitsa and Sivota are thriving with lower entry prices and expanding ferry connections to Italy, boosting rental demand. Volos City combines a growing university population with underdeveloped tourism infrastructure, while Larissa has seen a 12% price increase since 2021 as remote workers relocate from Athens. Remember, chase the numbers, not the postcard views. Pitfall number 10, the foreign investor premium. My final pitfall might be the most important. As a foreign investor, you're likely paying more than locals for the same property. The Bank of Greece found that foreign buyers paid an average of 22% more than locals for comparable properties in 2023. On islands like Paros and Naxos, 60% of transactions above 400,000 euros involved foreign buyers between 2020 and 2023. This creates two problems. You're starting your investment underwater compared to market value, and you're in a market where local purchasing power hasn't kept pace with prices, making future resale much more difficult. So, there you have it. 10 pitfalls that could save you from making costly mistakes in Greek real estate. Does this mean you shouldn't invest in Greece? Not at all. A 2023 study found that properties in strategic locations, so within 500 meters of universities or metro stations and with over 40% local buyers, earn 12% more than impulse purchases in tourist areas. The key is research, patience, and focusing on fundamentals rather than emotions. Have you considered investing in Greek property? Or have you already taken the plunge? Share your experiences in the comments below. If you found this helpful, smash that like button and subscribe for more real estate investment content. Until next time, bye bye!